If you're 65 or older, there's an IRS deduction that many retirees either misunderstand or completely miss. And for some people, this one deduction alone can reduce taxable income by thousands of dollars each year. Not because of a loophole, not because of anything risky, but because the IRS treats people over 65 differently than younger filers. The problem is that the rule is buried inside the tax code. It's not advertised, and many retirees assume they already get everything they qualify for. That assumption costs money. So let's slow this down and talk through it clearly. No tax jargon, no confusing charts, just what this deduction is, who qualifies, and why it matters more after age 65. First, it's important to understand one thing. This deduction does not come as a check. It doesn't show up as a credit, and it doesn't require special paperwork for most people. It works quietly in the background by reducing how much of your income the IRS is allowed to tax. That's why it's easy to miss. Now here's the key idea. Once you turn 65, the IRS allows a larger standard deduction. This is automatic. You don't need to itemize. You don't need to apply. You don't need to prove hardship. Age alone qualifies you, and that extra deduction can shield a surprising amount of income from taxes. Now let's talk about why this matters more in retirement. Most retirees live on fixed or semi-fixed income. Social Security, pensions, retirement account withdrawals, interest income. Even a small reduction in taxable income can noticeably reduce taxes owed. Sometimes it can eliminate federal income tax entirely. That's not an exaggeration. Now let's address a very common misunderstanding. Many people believe deductions only matter if you itemize. That used to be true for some deductions, but not this one, not this. This is part of the standard deduction. That means you benefit even if you never itemize anything. That's why it applies to so many seniors. Now let's talk about how big this deduction really is. The base standard deduction already removes a large portion of income from taxation. But once you're 65 or older, the IRS adds an extra amount on top. And if you're married and both spouses are over 65, that extra amount doubles. That's where the thousands of dollars comes from. Not all at once, but every year. Now let's pause here for a second. If you've ever wondered why some retirees with similar income pay very different taxes, this is often part of the reason. Age changes the math. Now let's talk about Social Security, because this is where things get interesting. Social Security benefits are taxed based on your total income. The more income you have above certain thresholds, the more of your Social Security becomes taxable. This deduction lowers the income the IRS looks at. That means it can indirectly reduce how much of your Social Security gets taxed. Again, quietly, automatically. Now let's talk about retirees who say, I don't make enough to owe taxes anyway. That might be true. But income changes over time. Withdrawals increase. Interest grows. Required withdrawals eventually begin. This deduction becomes more valuable the longer you're retired. Now let's talk about something else that surprises people. This deduction applies even if you are still working. Age matters, not work status. If you're 65 or older and still earning income, this deduction still applies. Now let's keep moving, because we still haven't talked about how this deduction works for married versus single filers, how it interacts with other income sources, and why some seniors still miss it, even when they qualify. Now, let's talk about how this deduction works differently depending on whether you file as a single person or as a married couple. For single filers who are 65 or older, the IRS adds an extra amount to the standard deduction just because of age. That extra amount reduces taxable income before any tax rates are applied. So if you earned a certain amount last year, the IRS pretends part of it never existed for tax purposes. That's the simplest way to understand it. For married couples filing jointly, this gets even more interesting. If one spouse is 65 or older, the deduction increases. If both spouses are 65 or older, it increases again. That means a married couple over 65 can protect a much larger portion of income from federal taxes than a younger couple with the same income. This is one of the quiet advantages built into the tax system for older Americans. Now let's talk about why some seniors still miss this deduction, even though it's automatic. The deduction only works if your filing status and age are entered correctly. That sounds obvious. But mistakes happen. Dates of birth entered incorrectly. Filing status not updated after a spouse turns 65. Returns copied year after year without review. These small issues can prevent the extra deduction from being applied. And because the IRS doesn't send a notice saying you missed this, many people never realize it. Now let's talk about tax software and preparers. Most modern tax software applies this deduction automatically, but only if the information is correct. If you're using old software, or if information was carried over incorrectly, the deduction can be missed. The same is true with preparers. Even good preparers rely on the information they're given. If something is outdated, the deduction may not be applied properly. Now let's talk about how this deduction interacts with retirement account withdrawals. Withdrawals from traditional retirement accounts count as taxable income. That income stacks on top of everything else. The larger standard deduction for seniors helps absorb some of that income before taxes apply. That means you may be able to withdraw more while paying less tax than you expect. This doesn't mean withdrawals are tax-free. It means the first portion may be shielded. Now let's talk about interest income. Many retirees earn interest from savings accounts, CDs, or bonds. Interest income is taxable. But again, the deduction reduces how much of that income is exposed to taxes. This is why some retirees earn interest but still owe little or no federal income tax. Now let's talk about pensions. Pensions are fully taxable income. They don't receive special treatment, but the deduction still applies against that income. For retirees with modest pensions, this deduction can significantly reduce or eliminate federal taxes. Now let's slow down and address a common question. Some people ask, if this deduction is automatic, why does it save thousands? The answer is cumulative effect. It saves money every year. It reduces taxable income year after year. Over time, that adds up to thousands of dollars kept instead of sent to the IRS. Now let's talk about another misunderstanding. Some seniors believe this deduction replaces other deductions. It doesn't. It replaces itemizing. If the standard deduction plus the age-based increase is higher than itemized deductions, the standard deduction is used. That's why so many seniors benefit from it without doing anything special. Now let's keep going, because there's another layer to this that matters a lot for people over 65, especially those receiving Social Security. Now let's talk about how this deduction quietly affects Social Security taxation, because this is where many people see the biggest impact without realizing why. Social Security benefits are not taxed the same way as other income. Whether they're taxed at all depends on your total income. That includes things like retirement account withdrawals, pensions interest, and other taxable income. The IRS looks at that combined number to decide how much of your Social Security becomes taxable. Here's where the age-based deduction matters. That deduction lowers the amount of income the IRS counts before applying tax rates. When that number goes down, it can change how much of your Social Security is considered taxable. For some retirees, this means less of their benefit is taxed. For others, it means none of it is taxed. And this often happens without them realizing why. They just notice their tax bill is lower than expected. Now let's talk about a very common scenario. A retiree receives Social Security and takes a small withdrawal from a retirement account. Without the extra deduction, that withdrawal might push income into a range where Social Security becomes taxable. With the deduction, the same withdrawal may stay below that line. Same income, different outcome. That's the power of this deduction. Now let's talk about retirees who say, my Social Security isn't taxed anyway, so this doesn't matter to me. That may be true today, but income changes over time. Withdrawals increase, interest rates change, required withdrawals eventually begin. What doesn't matter now may matter later. This deduction becomes more valuable as income grows. Now let's talk about widows and widowers, because this group often experiences the biggest shift. When a spouse passes away, income may not drop much, but filing status changes, and the standard deduction rules change too. The age-based increase still applies, but thresholds are different. This deduction can help soften that transition by shielding more income during a difficult time. Now let's talk about people who continue working after 65. Many people assume deductions are only for retirees who stop working. That's not true. If you're still working and you're 65 or older, this deduction still applies. Your wages are still income, but the IRS allows more of that income to be shielded simply because of age. Now let's talk about something else that often confuses people. This deduction does not depend on how old you are at the end of the year. It depends on whether you turn 65 during the year. That means the year you turn 65, you qualify, even if your birthday is late in the year. That surprises many people. Now let's slow this down again. This deduction doesn't require planning tricks. It doesn't require timing games. It's built into the system. But understanding it helps you make better decisions about income. Now let's talk about retirees who intentionally keep income low. Some people do this out of fear of taxes. They avoid withdrawals. They avoid interest. They avoid income. But that strategy can create problems later. The age-based deduction gives you room. It allows some income without immediate tax consequences. Using that room wisely can reduce future stress. Now let's keep going, because there's another important piece to this that many people misunderstand, especially when they hear saving thousands. When people hear that this deduction can save thousands, some assume it must involve a complex strategy or a special situation. But most of the savings come from something much simpler. It's the difference between being taxed on income and not being taxed on it. Every dollar that falls under the deduction is a dollar the IRS does not apply tax rates to. If your tax rate is modest, the savings may feel small in a single year, but over time, those savings compound. Year after year, that protected income adds up. That's where the thousands come from. Now let's talk about retirees who take required withdrawals. Once required withdrawals begin, income is no longer optional. Money comes out whether you need it or not. This deduction becomes especially important at that stage. It helps absorb part of those required withdrawals before taxes apply. Without it, required withdrawals would push more income into taxable territory. With it, the impact is softened. Now let's talk about something retirees often don't consider: state taxes. This deduction is federal. Some states follow similar rules. Others don't. But even in states that tax retirement income, reducing federal taxable income can still help with planning. It may keep income below thresholds that trigger other costs. Now let's talk about another misunderstanding. Some people think this deduction disappears if you earn too much. It doesn't. There is no income cutoff for qualifying. If you are 65 or older, you qualify, even if your income is high. The deduction still applies. It may not eliminate taxes entirely, but it still reduces them. Now let's talk about charitable giving. Many retirees give regularly. Charitable contributions don't replace this deduction, but together they can significantly reduce taxable income. Understanding how they stack helps avoid overpaying. Now let's talk about record keeping again. Even though this deduction is automatic, it's still wise to review your return. Look for confirmation that the age-based increase was applied. It's usually listed as part of the standard deduction calculation. Seeing it there gives peace of mind. Now let's slow this down again. This deduction is not something you use up. It's not a one-time benefit. It's available every year once you qualify. That long-term nature is what makes it powerful. Now let's talk about retirees who file jointly where one spouse is younger. The older spouse still qualifies for the extra amount. The younger spouse does not yet. But once the younger spouse turns 65, the deduction increases again. This gradual increase is built into the system. Now let's talk about planning around birthdays. Some retirees delay filing or rush filing based on age. You don't need to do that. The IRS looks at whether you turned 65 during the year. The timing within the year doesn't matter. Now let's talk about confidence again. When retirees understand this deduction, they stop underestimating their after-tax income. They stop assuming every dollar withdrawn will be heavily taxed. That confidence helps with budgeting and decision-making. Now let's keep going, because there is still an important aspect we haven't covered yet. And it's one of the main reasons seniors unintentionally miss out on the full benefit of this deduction. One of the biggest reasons seniors miss the full benefit of this deduction has nothing to do with the IRS changing rules. It has to do with assumptions. Many retirees assume their taxes are already as low as they can be. They think, I'm retired, I don't make much, this doesn't apply to me. So they stop paying attention. That's when money quietly slips through the cracks. Another reason is habit. Some people file their taxes the same way every year. Same method, same software, same preparer, no review, no questions. When age-based deductions are first applied, they often go unnoticed. And if something is wrong, it stays wrong year after year. Now let's talk about retirees who don't file at all. Some seniors don't file because they believe their income is too low to require it. That may be true, but not filing can still mean missing opportunities. In some situations, filing can confirm that income truly is non-taxable. It also establishes records that help later if income changes. Now let's talk about partial year retirees. People who retired during the year they turned 65 often misunderstand how this deduction works. They assume it only applies if they were retired the full year. That's not correct. As long as you turned 65 during the year, you qualify for the increased standard deduction for that year, even if you worked part of the year, even if retirement happened late. Now let's talk about people who help others file. Adult children, caregivers, family members. They may be very capable, but they don't always know the age-based rules. They focus on income numbers and miss the age factor. That's another way this deduction gets overlooked. Now let's talk about the emotional side again. Many seniors don't like dealing with taxes. They find it stressful, so they aim to get it done quickly. But rushing increases mistakes. This deduction doesn't require effort, but it does require awareness. Now let's talk about IRS notices. The IRS will not send you a letter saying, "Hey, you forgot your age-based deduction." They assume the return is correct unless something is obviously wrong. That's why this deduction must be verified by the filer. Now let's talk about future years. Once you understand this deduction, it becomes part of your baseline thinking. You stop fearing modest income increases. You stop assuming every withdrawal will trigger taxes. You understand that a portion of income is automatically protected. That understanding changes how you plan. Now let's talk about retirees who worry they are doing something wrong by using deductions. This deduction is not aggressive. It is not a loophole. It is not something that raises red flags. It is part of the standard filing structure. Using it is not optional. It's how the tax code is designed. Now let's slow this down again. Nothing about this deduction requires action beyond correct filing, but knowing it exists helps you evaluate decisions differently. You don't avoid income blindly. You don't overestimate taxes. You make calmer choices. Now let's keep going because there's still an important layer to this discussion that affects how much this deduction really saves over time, especially as retirees age further. As retirees move further into their late 60s, 70s, and beyond, the value of this deduction quietly grows, not because the deduction itself changes dramatically, but because income patterns change. Withdrawals tend to increase, medical expenses rise, interest income may fluctuate, and required withdrawals become a bigger part of the picture. That means more income passes through the tax system. The age-based deduction keeps absorbing part of that income every single year. Without it, taxes would rise much faster for many retirees. Now let's talk about required withdrawals again, but from a different angle. When required withdrawals begin, many retirees feel like they've lost control. They didn't choose the amount. They didn't choose the timing. But this deduction is one of the few things that still works in their favor automatically. It reduces the taxable impact of withdrawals that can't be avoided. That's especially important for people who don't spend all the money they're required to withdraw. Even if the money is reinvested, it still counts as income. The deduction helps soften that reality. Now let's talk about longevity. People are living longer. That means retirement lasts longer. A deduction that applies every year becomes more powerful over time. Saving a few $100s in taxes each year may not feel dramatic, but over 10, 15, or 20 years, it becomes thousands. That's the long-term value many people overlook. Now let's talk about inflation. As prices rise, income often rises too. Social Security adjustments, interest changes, withdrawal amounts increase. The deduction helps keep pace. It doesn't eliminate inflation pressure, but it reduces its tax impact. Now let's talk about something else retirees often don't connect to this deduction: healthcare costs. While this deduction doesn't directly reduce healthcare expenses, it reduces taxable income. Lower taxable income can indirectly help with other thresholds. That's why retirees sometimes notice lower costs without knowing exactly why. Now let's talk about budgeting. When retirees understand this deduction, budgeting becomes easier. They stop assuming a worst-case tax scenario. They stop holding back income out of fear. They can plan more realistically. Now let's talk about peace of mind again. This deduction is predictable. It doesn't disappear. It doesn't depend on market performance. It doesn't require decision-making. It's one of the most stable parts of the retirement tax picture. That stability matters as life becomes less predictable. Now let's talk about one more misconception. Some retirees think this deduction somehow replaces other benefits. It doesn't. It works alongside Social Security rules, retirement income rules, and other deductions. It's additive, not subtractive. Now let's slow this down again. Nothing about this deduction requires urgency. There's no deadline. There's no rush. But there is value in awareness. Knowing it exists helps retirees stop underestimating themselves, stop underestimating their income, stop overestimating their taxes. Now let's keep going because there's one more subtle but important way this deduction saves money that many retirees don't notice at all. One of the most subtle ways this deduction saves money is by changing how retirees think about their income. When people believe every dollar they earn will be heavily taxed, they hold back. They delay withdrawals. They avoid income. They worry constantly. But when you understand that a portion of your income is automatically protected every year just because of your age, that fear eases. You begin to see income differently, not as something dangerous, but as something manageable. That shift in mindset leads to better decisions, more balanced withdrawals, more realistic budgeting, less stress, and fewer surprises. This deduction doesn't make taxes disappear, but it makes them predictable. And predictability is one of the most valuable things in retirement. You know that no matter what happens with markets, interest rates, or inflation, a certain amount of your income is shielded before the IRS even begins calculating taxes. That reliability matters, especially later in life. This is why so many retirees look back and say they wish they had understood this sooner, not because they could have gamed the system, but because they could have planned with more confidence. The IRS didn't create this deduction as a loophole. It exists because retirement changes financial reality. Income is different, needs are different, and the tax system reflects that. Understanding this one rule doesn't require becoming a tax expert. It just requires awareness. Awareness that age changes how income is treated. Awareness that not all income is equally taxed. And awareness that small, steady protections add up over time. If you're 65 or older, this deduction is already working for you, whether you noticed it or not. The value comes from knowing it's there, checking that it's applied correctly, and letting it do what it was designed to do. Quietly protect more of what you've earned. That's all this is. No tricks, no urgency, just clarity. And clarity is what turns retirement from stressful into sustainable. Thanks for listening.